Next tip. No, it's not too late. It doesn't matter if you're 50 years old and haven't invested a dime. You can open an account and buy a small position in a zero commission ETF right now. You could even buy just one share. You don't have to have a lot of money to start investing in the market. It's important to keep track of your portfolio's performance. Not every day, mind you, that'll just make you crazy. 401ks and investment accounts send you monthly statements on how your portfolio is performing. Use these to measure your portfolio against the S&P 500, the most common U.S. stock market index. The reason this is important is that if your portfolio is consistently underperforming the S&P, you might as well sell all your investments and put all the money into the S&P 500 index. Don't worry about beating the market until you can at least do as well as the market. Something I've learned over the years is that the U.S. economy is based on consumption and consumer spending. With all that focus on spending, you need to remember that you have to save too. I just read that 50% of Americans have less than $25,000 saved for retirement. You can't complain about having to work late in life if the reason you're working so much is because you haven't saved. You've probably heard this before, but it's good advice. If you're not saving much, cut down on your expenses. Get a drip coffee instead of that fancy latte and throw that change into your portfolio. Try to add a little bit once a month, every month, and stay disciplined. Resist the urge to chase. You'll notice that some investments are going up farther and faster than other investments. This is okay. Your bond positions will go up slower than your mutual fund positions. If the economy is in an expansion, you may find that your small cap ETF is doing better than your large cap. Perfectly fine. If you try to chase whatever's moving the most, you'll be trying to time the market. You'll also notice that the faster movers are more volatile. Emerging markets are notoriously volatile. They can go up a lot very quickly, but can also go down a lot the same way. They say that markets seem to take the stairs on the way up and the elevator on the way down. It sucks when you chase, throw a bunch of money into some ETF because it's skyrocketing, only to have jumped into the elevator just before someone hit the down button. If you're interested in talking to an advisor, I highly recommend an independent one. This is based on my own experience with advisors. If you meet with an advisor, ask yourself, or better yet, ask them, why are they recommending that particular fund? Did they get a commission for selling that fund over a similar one? Does their company have any affiliation with that fund company? Check their recommendations for fees or loads. Feel free to walk away from any advisor you feel is trying to push you into something. An independent advisor is less likely to put you into some mutual fund because his company is giving a bonus to the advisor that sells the most shares that month. Watch the financial news. Pay attention to world events and especially watch the Fed. Again, you don't have to do this to be a successful investor. You can blindly dollar cost average into a diversified portfolio of a certain allocation and you'll be way ahead of the game. But if you're interested in maybe paying a little bit more attention, it can be very useful to pay attention to the most basic financial news. The actions of the Fed are usually interesting and can move the markets a fair amount. It's at least helpful to know if the economy is in an expansion or a recession, and if interest rates are going up or going down. I don't recommend trying to time the market, but for those that want to get a little bit more advanced, I don't see the harm in moving into a more aggressive allocation when the economy is expanding and interest rates are low, and then moving into a more conservative allocation when rates are rising and a recession may be near. I highly suggest you look for more information on the web about the Fed, interest rates, the yield curve, and stuff like that. Just remember to focus on your main allocation first and foremost. Know the difference between trading and investing. I recently read a book that said it was all about investing using a, quote, big picture macroeconomic view. I was interested in learning more about macroeconomic stuff, so I was excited to read the book. I was so mad after reading the first chapter about how you were going to need to get a fast computer with 2 monitors side by side so you could have all your charts and graphs on all these stocks you were going to look at. And it went on and on about doing hours and hours of study on stocks and stock screens and limit orders and slippage and all this stuff. It's kind of why I'm making this video. I thought the average Joe is going to be freaked out by this. They're not going to be sitting in front of dual monitors checking out a bunch of charts. We don't have time to do all the research these guys are talking about, and some of us don't have $100,000 to invest. It's stuff like that that makes people think you have to be a financial guru to manage your own portfolio. That's the kind of stuff that scares people. Stupid book. No, that guy was talking about trading. And for trading, you do need to do a lot more homework. And you have to be worried about using limit orders and stuff like that. For long-term investors, it doesn't matter as much if Apple stock drops 5% tomorrow. 5 or 10 years from now, Apple stock could have split a few times over. If you hear or read something about the stock market, ask yourself if they're talking about trading or investment. If they're talking about trading and you're not a trader, then don't worry too much about it. Now, on the subject of trading, I purposely didn't talk much about buying stocks in this video. If, however, you do want to buy and hold some stocks, or even trade some stocks or ETFs, I have a few tidbits that might be helpful. Alright, this should be pretty obvious. Don't buy a stock because someone told you it was about to shoot higher, or you saw a fax in the machine at work, or whatever. It's pretty obvious, but I had to say it though. Pay no attention to internet message boards. It's really the same thing as that first one. You wouldn't listen to a guy on the street going, "Psst, hey buddy, come here, I got this great stock tip you need to hear." So why listen to it on the internet? You also see these guys talking about how they bought at 10 and sold at 100, and they always seem to time everything just right. That's because they are lying. Don't fall for stupid stuff posted on the internet, please. Also, if you spend any time on the internet, you've by now found out that most comments on the web are negative. For some reason I don't understand, a lot of people who write on comment boards are jerks. That's why I've disabled comments on this video. Internet message boards are a complete waste of time, and someone smarter than me can reflect on what that says about our society, but I suggest you just avoid them. Oh man, this one irks me. If I hear that you went and bought a penny stock, I will find you and I will slap you silly. Luckily, penny stocks are kind of hard to buy because real brokerage houses won't let you. These are tiny stocks of maybe not even real companies that people like to buy because they only cost pennies, and a rise of 3 cents translates into huge market gains. The problem is what's called liquidity. If you heard the news in 2008, 2009, you may have heard that word, liquidity. Penny stocks are like roach traps. You might be able to get in, but you can't get out. For you to sell a penny stock, someone has to be on the other side waiting to buy it from you, and there just aren't a lot of people in these things. So getting out can be impossible. Also, a lot of time, these are just scams. The person trying to sell you the penny stock already has his shares at a lower price. He's trying to get you to buy them from him. Don't be the sucker. Now, if you plan to trade or try to time the market, because that's essentially what trading is, then you need to know how to do it efficiently. You need to know the types of orders and how to enter them. A lot of people think that they can buy a stock at $10 and put in a stop at 9, thus limiting their potential losses. But what can happen is that they can wake up one morning and find that their stock has plummeted to $5 a share in the after hours. Now the stock opens at $5, their position sells for a huge loss. Stop loss or stop limit orders cannot save you from gap downs. And then you'll ask, well, if all the action is happening after hours, how can I get in on that? I've looked into that one myself, to be honest. The short answer is you can't. The stock market is open to regular Joes like you and me from 9:30 in the morning till 4 p.m. Eastern Standard Time, and that's it. Don't trade on margin unless you really know what you're doing. Trading on margin means you get to borrow money in order to buy more stock. Sounds good until you lose money on a trade and the firm that loaned you the money wants it back. Don't think the margin is free borrowed money. They can liquidate the rest of your portfolio to get their money back when they want it. It can be very dangerous. Proceed with extreme caution. If you've made a few good trades in a row, don't get cocky. Trading on margin works great when you make a good trade, but it hurts like a bastard if the trade goes against you. You need to be good at taking losses, not just at collecting profits, before you can think about trading on margin. Earnings season. More than once I've been burned by earnings season. If you're going to buy a stock, know when it's going to report earnings, or wait until it does. Companies report earnings once per quarter, and it's pretty complicated. There's the earnings estimate, then the whisper number, then the guidance, and then there's intangibles like the conference call. All of these things can move a stock. The company can post great earnings, but a lousy guidance may send the stock free falling. The company might have great earnings and guidance, but then a bigger fish in the same pond might have bad numbers and send the entire sector down. The CEO could sound depressed on the conference call, and that could make the stock move in an unexpected direction. It's a very volatile time for a stock, so you might want to wait for all that dust to settle before you make a move. Buy on the rumor, sell on the news is real. There's a lot of old adages on Wall Street like the trend is your friend, which it is, and don't fight the Fed, which is also a good one. But I highlight the buy on the rumor adage because as average investors, you and I aren't really privy to the rumors that the pros are buying on. And some of those rumors that the pros are buying on aren't entirely legal, and you see them go to jail from time to time. It's kind of a reason why average investors are often late to the party. We see stocks moving and we have no idea why. Then we see some headline saying something good, so we jump in. As soon as we do, the market tanks. Someone else bought on the rumor, causing prices to go up. We bought on the news, and now we're left holding the bag, as they say. Just something to be aware of. And finally, there is no such thing as a free lunch. If you read a financial magazine or see a TV show, you'll see ads for these things that talk about making a lot of money quickly in the stock market. There'll often be these black box things where you pay a fee and the box spits out a stock to buy, and a point to buy it and a point to sell it. As I assume you've already guessed, these things are scams. If someone had a computer program that could consistently tell you exactly when to get in and out of a stock, the program wouldn't be for sale to the general public. And if it was, there'd be about 1 billion billionaires in the world. So don't fall for these scams. And so that's it. Thanks very much for watching my video. I hope you found it informative and have decided that investing for the future and managing your own portfolio is something that you're going to start doing right now. You see my email address there on the screen, easystreetguy@gmail.com. Feel free to email me with any feedback or questions you might have. Thanks again, and good luck out there.